Welcome to the MTA Podcast Series, a weekly audio cast featuring interviews with recognized industry professionals. And your host, Ed Carlson.
Tuesday, March 9th, 2010. Today's guest is CNBC fast money trader Jon Najarian. Jon Najarian is a professional investor, noted media analyst and speaker, and co-founder of Optionmonster and Trademonster.com. Following a brief stint as a Chicago Bears linebacker, the Bears, Jon launched his financial career at the Chicago Board Options Exchange in 1981, trading in the pits for some 25 years. In 1989, he founded Mercury Trading, running the company for 15 years until 2004, when he sold its floor trading operations to Citadel. More recently, Jon has developed and patented trading applications used to identify unusual activity in stock, option, and futures markets. Most notable is the Heat Seeker program, which uncovers extraordinary buying patterns from among the millions of quotes per second that stream from America's stock, options, and futures exchanges. In addition to OptionMonster.com, Jon's research and analysis is widely cited by leading financial media, including the Wall Street Journal, Barron's, Reuters, and Bloomberg. Jon is a CNBC contributor and webcasts on CBOE TV. Dr. J, welcome to the program.
It's my pleasure. Thank you for having me today, sir.
Well, we're delighted to have you with us and really appreciate you making the time in the middle of a busy trading day, or what is normally a quote-unquote busy trading day. Professional athlete, floor trader, and computer geek. Give us some personal background on yourself, Jon. How did you get from football to the CBOE and from there to Trademonster and fast money?
Sure. Well, I came to Chicago to play football for the Bears, and I was a free agent. So at that time, the Bears were pretty bad. And when they approached me, that seemed like my best possibility of becoming a professional athlete was to go with the team that had, at least in my mind, some of the least talented linebackers. And, you know, being a linebacker that was a free agent, I understood that I was also one of those least talented. So you don't want to go to a team that has 3 All-Pros, for instance.
Not if you want to play.
Right. So I came to Chicago. Unfortunately, one of the linebackers was hurt and lost for the rest of his career due to some nerve damage during training camp. Another linebacker quit, and so my odds seemed to be moving in my favor pretty nicely until Mike Singletary really started to show why the Bears drafted him in the second round and not me. And so Mike did a great job as a linebacker. Of course, he's a Hall of Fame player, and when it came time to choose between me and Mike Singletary, I think the coaches did the right thing and they picked Mike Singletary. But that did give me the opportunity while I was in Chicago to meet a bunch of people on the trading floor, because back in those days we used to practice right up at Lake Forest, which is about 30 miles north of downtown Chicago. And a lot of the traders from the floor, in particular the grain traders, they finish at 1 o'clock, some of those guys. So they're already home by 3 o'clock, and they would come out and watch us practice. So when I did get cut, the opportunity to play football not really being an option anymore, I came down to the floor and worked as a clerk, and then eventually worked my way into a position where I bought a small seat with the money I made playing professional football, and then I started learning the game, you know, basically eating my own cooking, as I like to say. And knock on wood, it worked out. I figured things out. I wasn't a genius or anything, but I started, and the markets were in the beginning of a run back in 1981 that carried them up until the crash of '87. And we had a whole bunch of new things that happened to the market, not the least of which, of course, was additions of a bunch of new option exchanges over those next several years. So the popularity of the product really helped me out. I got there. I guess my timing, as bad as it was with the Bears, was really good with the financial markets.
When one door closes, another opens. Okay, so you're on the floor of the exchange, and at that point, did your brother Pete join you, or when did he enter the picture?
Well, Pete was playing professional football after me. I'm 6 years older than Pete. So he was playing football after me, first in, of course, high school and college, and then in pros. And while I was trading down on the floor, one of the things that became apparent was that much of it was very secretive. The traders tended to hold on to the knowledge if they had something that was unique to them. They didn't want to share it with others for obvious reasons, because it could enrich you dramatically. So if you really wanted to advance your career in trading to the extent that you could develop computer programs and models, you were going to be a richer trader. So that's more or less how I became self-taught in coding for computer programs and so forth. And even though I'm not, on a par with the people that do that kind of coding today, it got me to the point where I could develop programs to track unusual activity. And then when my brother Pete joined me in 1991, that's when the firm really had started to take off right at that point. So I had a 10-year head start on him, but Pete was very quick, very aggressive, very smart, and he helped me grow the firm to us having traders on the New York Stock Exchange, the Pacific, the Philadelphia, Chicago here, and basically turn it into more or less a regional powerhouse as far as trading, and we had a lot of fun in the meantime.
Mm-hmm, mm-hmm. Well, we're going to talk about the way you guys go about trading your options in a few minutes, specifically the Heat Seeker program. But before I forget, you say you're self-taught when it comes to computers. That's interesting. You're talking to somebody that needs to do some self-teaching. What do you do to teach yourself to get to the point where, particularly when you're working a full-time job that is, to say the least, somewhat stressful, and running a business, how do you teach yourself to write computer programs?
Well, I more or less, back in those days, of course, there weren't, the internet wasn't like it is now as far as a delivery vehicle for information. So instead, you just had to, the coding was much more basic back then. Even though it was more difficult at times, it was much more user-friendly, if you will, in terms of there wasn't the complication of that speed introduces to the problem. So as speed, as the internet picked up the delivery times and made it faster and faster and faster, it made it such that I could take very basic programs that were basically just searching for blocks of options and enhance those with the speed of being able to search very, very quickly between the speed of the internet and the speed of the computers, both ramping up dramatically in weekly, if not daily fashion. I mean, we were moving faster and faster each time I got a new computer. I couldn't believe how much faster it was than the old one. But basically, to answer your question, I sat with guys who were doing the same sort of thing as me, who were trying to create programs to do to track unusual activities in the markets and or just looking for patterns in the markets, and we all more or less helped each other out because as much as things that were developed were secretive, things that were being developed were not secretive, and so there was almost like a support group of other traders that were trying out as far as here's the step that can cause you to move much faster through the equation if you just jump over this. So that's more or less how I did it. Plus, I had a decent background in math and science, and it wasn't a huge leap for me to move into computer programming.
Ah, okay. Now the secret comes out. The football player actually knows math and science. You're quite an eclectic person, Mr. Najarian. All right, so that takes us through your time on the floor of the exchange, Trademonster, and somehow I need to figure out how you ended up on the television set in my living room. Can you tell us about that transition?
Sure. Basically, Fox first, and then CNBC second, offered me opportunities to come on TV. For the better part of a decade, I did that for Fox, and they tend to be, of course, pretty proprietary, and once you start broadcasting for them, they'll make you sign a contract that you can't go on anybody else's airwaves.
Sure.
So for 10 years, I was exclusive with Fox, And then in about 2005, I started being solicited by CNBC as my Fox contract ended, and I ultimately went on with CNBC, at first on once-a-week basis, then on a couple times a week, and now I'm on every day on CNBC. And that all just came about really because they began developing shows targeting individual investors and, in particular, proactive investors or high-frequency investors, people that don't just buy and hold for years and years, but people that are trading in and out, active day trader types, because those were both attractive for them as a viewing audience and attractive to their advertisers. So CNBC was active in trying to find people like me, like Pete, like Guy Adami to put on their shows because they thought that we were talking the language that the people that were active traders understood.
Mm-hmm. And it's hard for a lot of folks to get it anywhere else. Let's talk about fast money. I was hoping maybe you could give us some behind-the-scenes insight as to what goes on there. For example, what about show preparation? There's only an hour between when the market closes and you guys have got to go on live national television. What is done to prepare you for the topics that are going to be discussed? Does a sheet of stocks go out telling everybody, okay, here's what we're going to talk about, be prepared? Just what happens between the market close and when the lights come on?
Sure. Well, indeed, just as you say, they'll put out a list of all the different times, they'll call them blocks. A block, which might be the first 15 minutes, then B block, C block, and D block.
Okay.
So they're basically breaking the hour up into quarters and saying in this block we might talk about Cisco because Cisco's just had news out today, or we might talk about research in motion because it's breaking out, or we might talk about Clearwire or any of these kinds of situations. So then they would say, be ready to talk about anything about that. If you have anything special about it, please shoot it to us so that we can get it in what they call the rundown. But nothing for us anyway, nothing for the traders is scripted. So for that fast money show, we have a rough idea of the stocks they're going to talk about. We have to sign a disclosure document at the beginning of every show saying if we own those stocks or if we are soliciting business from those companies or anything else, so that in full disclosure they can put it out to the public so the public knows John owns this stock, he is adding to his long positions or whatever it might be. And we're the only people at CNBC that they let do that. The rest of the folks on the network, except for Jim Cramer and the folks on Fast Money, none of the people that work for Comcast, General Electric can trade. They all have to own stocks through mutual funds or ETFs, and they have to only trade during certain times of the year.
Interesting.
Yeah,
what is it?
Want them to do pump and dump schemes where they buy a stock, talk about it, and then sell it while the stock's going up.
Sure. What is a rundown?
So the rundown is a list of all the different stocks that we're going to talk about on the show in no particular order, and then saying, okay, we're going to bring on a guest from, for instance, Cisco tonight that's going to talk about this new router that they've developed. So then they'll say, have questions ready for him or her, and that rundown would break it up in every 15-minute segment of the hour what would likely be occurring. But again, since it's live TV and it's not scripted, it can run over, or, you know, a lot of stuff that's on the rundown never gets talked about because we run out of time.
I see. Okay. One more question about fast money and then we'll move on. It's something I've always wondered about. You know, when you have a phone-in interview, somebody calls in to do the interview and they just put his photograph up there on the screen. And while they're interviewing that person, say Melissa Lee's asking him or her questions, the camera will often go, in order to provide some viewer relief, I guess, it will flash between the other four of you. And I've often wondered, is there a little monitor under the camera that you can look at and see whether you're on or off camera? Because sometimes that camera will hit one of you and all of a sudden your expression will change like, oh, I'm on. Does that make any sense? How do you know when you're on?
Well, just as you say, there's a red light on top of each camera when the light comes on, but you never know when it's going to be, when they're going to pick you and your expression.
Right.
But the other issue is that you've got the producer in your ear, and he might say, John, look up, we're going to you now. And so you'll look up just at that because you're probably checking your computer to see, what other stocks are moving in the after hours or whatever the next segment might be that you're getting ready to talk about. And they'll say, look up, because you're looking not into the camera but away from it.
Yeah. We're going to continue with Jon Najarian, the pit boss, in a moment. But first, a reminder that on next week's program, we'll have Fast Money regular Dan Fitzpatrick. John, we usually like to to ask guests about their toolbox. That is, what indicators they follow. Now, I don't believe you make a claim to be a technician, although I see this morning at Option Monster you're talking about different formations on Cisco. Why don't we just shoot to the chase here? Do you use much technical analysis, and if so, how deeply do you get into it?
I don't use much technical analysis. I do pay attention to it, and I look at which stocks, for instance, are right up against resistance or just bouncing off of support.
Okay.
And I use technical analysis just to look at gaps, the same way I use short interest in terms of the stock to find where a stock might feel some lift from if there's too large of a short interest, like there is in a few stocks that we're tracking. Then we figure, okay, between the chart pattern in the stock and the short interest, and now this option activity that we're citing on Option Monster, here's why we think the stock could make a dramatic move in the next few minutes or in the next few days. So I pay attention to technical analysis, but I am by no means a technician.
Mm-hmm. That last comment takes me to another point I've got in my notes. In your blog or whatever you call it at Option Monster, you're always talking about unusual amounts of option activity in a particular issue, and I assume you're using your heat seeker program to capture that information. Is that pretty much the basis of what you're doing for trading your own proprietary accounts, or in addition to what you just told us about the technical analysis you used, or is there more to it? And can you expand on this heat seeker program and give us some more insight into that?
Sure. Basically, what we're doing, folks, is we're looking for patterns in the market that indicate that a big institution is buying calls, which would be a bullish pattern, or buying puts, which would be bearish. And the way we determine it is we use a 10 gigabit connection to the internet along with 6 1 gigabit connections to the internet. Those 1 gigabit connections are 600 times faster than a T1. And we need that kind of speed because the information that is available from the exchanges where these options or stocks or futures are trading is far too rich. In other words, there is too much information. Each option exchange is pushing out about 100,000 quotes per second, and at times pushes out more than that. So you've got 7 competing options exchanges. That means we've got at least 700,000 or 800,000 quotes a second, and we're looking for that needle in the haystack. Where is the George Soros type or the Warren Buffett type buying going on right now? And so it's very easy for them to hide given how thick or how much data there is out there. So we need to be able to break it all down into, to parse it, if you will, into milliseconds and see where indeed the buys were occurring and where the sells were occurring, so we know that there's a big institution getting involved. And then that's the side that, like a surfer, we will start aggressively paddling to get onto that wave, whichever way they're getting, long or short.
Interesting. Now, okay, so obviously you use this information as more of a momentum approach, but it probably won't surprise you to know that an awful lot of technicians out there would look at an overwhelming number of options being traded either side of the market and think of a contrarian approach. Can you share with us where would you draw the line? How would you decide, whoa, that's just too much, that's a bubble?
Well, and that's a great question. The part that I hadn't described yet was that we're looking for institutional buying. So customer volume or retail is where you get bubbles. Retail, which shows up as 5 contracts, 10 contracts, 20 contracts, is not what the big guys and big gals are trading. The big guys and gals are buying 1,000 contracts up to 5,000 contracts in the same second. And so those are significantly bigger chunks of money. They're buying, like I say, 3,000 or 4,000 calls that are at the money that would represent perhaps $500,000 worth of option premium. And I want to follow those guys. I don't want to follow exactly what you described, the bubble. If I see a whole bunch of 10 lots and 20 lots, that's describing to me a situation where we've got the public in there and not the institutions. So we filter out the public just looking for the institutions.
Interesting. Jon Najarian, we are just about out of time. I'm going to leave with one last quick question. I hope it doesn't catch you by surprise, but I'm really interested in your opinion on this. What would you say is the most common mistake that not a novice, but let's say an experienced trader makes with options?
They don't give themselves enough time to be right. When our systems, for instance, show unusual buying right now, here we are in the final 2 weeks of the March cycle. If I see unusual volume in March, I will almost always trade April options instead, unless there's an earnings report due after the bell. I will trade earnings differently. But if it's not earnings related and I see unusual option activity in March, if I'm bullish, I will buy April, because the March options, there's too much odds stacked against those calls or puts being right because there's only a few days left in the cycle. So I think even experienced traders see that frenzy of activity and they buy the short-term option. They don't have enough time to be right. Those options expire next Friday, and then it's bye-bye, and they have to get back in and jump into the more expensive options at the higher price.
Right. Okay. Wow. Jon, it's been wonderful having you with us today. As I said at the beginning, we really appreciate you making the time in the middle of a trading day. Before we conclude, is there anything else you'd like to mention?
Sure. And thank you. First of all, great to be on with you. Even for a limited time like this, we'll have to do it again. And please just check out some of the offerings over on our sister company, Trademonster, because not only is it a deep discount broker, just $7.50 for stock or 50 cents for options, but it's also got great tools, and you don't even have to fund an account to use the tools. I'm confident if people use the tools, like the strategy seeker and things like that on the website, that they'll not only become a better investor, but they'll also end up being one of our customers in the near term, because it's just very compelling, cutting-edge kind of stuff.
I see. Well, that's great. Thank you, Jon. And that wraps up today's MTA podcast. From Seattle, I'm Ed Carlson. You can follow me at seattletechnicaladvisors.com or contact me at ed@seattletechnicaladvisors.com. Send us your comments and suggestions. Let's keep our stops tight. Good day.